Many accountants prefer to maintain a single fixed asset register for their clients' businesses. And since tax depreciation tends to be much more aggressive than accounting depreciation, basing fixed asset registers solely on tax rules seems like a great choice. But aside from distorting the true value of assets to a business, depreciating too aggressively reduces the value of those assets on the balance sheet as well as reducing profits on the P&L, therefore undervaluing the business. Let's consider a really simple example. XYZ Gym Group opens a new gym. They've leased the premises, purchased equipment and secured some foundation memberships. Scenario 1. Tax depreciation equals accounting depreciation. In this scenario, XYZ fully depreciates the gym equipment under the accelerated depreciation tax concessions, and the accounting depreciation is the same as tax, which is $250,000. The first thing that stands out is that XYZ ends up with a small tax loss carried forward for the year. That is, it doesn't pay any tax because they were able to fully depreciate the assets for tax purposes. But since they've used tax depreciation rules for their accounts as well, XYZ ends up with no capitalised assets and negative equity on the balance sheet. The P&L also looks pretty bad. This will have a significant impact on XYZ should they try to go to the bank to borrow, to open a second gym, or to acquire more equipment for the existing gym. Scenario 2. Tax depreciation does not equal accounting depreciation. The typical useful life for gym equipment is 10 years, so from an accounting perspective, XYZ could depreciate these assets using the prime cost, otherwise known as straight line method, over 10 years. XYZ would depreciate 10% of the value of the equipment, leaving the capitalised assets on the balance sheet with only a small depreciation expense on the P&L. The result? XYZ ends the year with positive equity and a nice profit for the new year. This is both a more accurate reflection of the true value of the business and puts XYZ on more solid footing with current and future creditors. Wouldn't it be great if there was an easy way to manage tax and accounting depreciation side by side? Asset Accountant makes it easy to define the tax and accounting treatment of all your fixed assets and provides a complete range of capital allowance depreciation methods and reporting. Asset Accountant can save you significant time in managing fixed assets while giving you the confidence that you're optimising depreciation for both tax and accounts.